What's up there, YouTube? This is James here with Abbey Finance again. Today we're going to take a look at the S&P 500 and do a little bit of a history lesson on the stock market. So as you can see here, over the past year, the S&P 500 has returned over 20%. And that's on the high end of average performance for the stock market in 1 year. Typically, S&P 500 average around 8 to 10% per year over a really long time. So as you can see, the market had a very good year. Now, looking at 2 years, around 11%. So the S&P 500 has been performing around 5.5%, 5.7% each year. So that's a little bit lower than the long-term average performance. Stretching it out to 5 years, though, you can see 72% return over 5 years is actually closer to about 12, 15%. So again, over a 5-year period, the S&P 500 is outperforming its long-term average. Now looking at it at a 10-year period, 62% return divided by 10 years is a 6.2% return. A little bit on the low end of its long-term average, but there's been a couple significant events that have happened over the past 10 years. As most of you know, there was a financial crisis around 2007, 2008, 2009. So this was surrounding the real estate bubble. So as you can see here in October of 2007, this was when the stock market was at its peak, the real estate market was at its peak, and the result of that was actually a 50% decline in prices, even 56%. So since 2009, the market has gone on and tripled because while the market was once extremely overvalued because there was a bubble in asset prices, the market overcorrected in the wrong direction, in the opposite direction. And the market declined by about 50%, and since then the market has tripled, as you can see here. Tremendous returns. So since the stock market has tripled, though, in 2009, there have been very few, if any, meaningful declines. I would say there have been no declines over 20%, and definitely no declines even approaching 50%. With that being said, I could lose over $5,000 or over 50% of my portfolio anytime soon here. I would say that the economy, the stock market, are well overdue for a correction, even a bit of an economic crisis. While it's unclear what might cause that at this point, I just need my listeners and myself to be aware that my portfolio is very risky as it holds 100% equities, 100% stocks, and there's been bull market for the past 8 years, and very, very few declines have occurred at all. In the past year, there have been 2 meaningful declines. So as you can see here, in June of 2016, the market dropped with Brexit. Dropped by 5% in just 1 week. The next meaningful event that occurred was actually Election Day. Usually politics don't play too much into the stock market and financials, but actually, as you can see here, over just a period of a week or two, there was about a 3% decline. November 4th was Election Day, and that's actually when Donald Trump was announced president. So that was, again, another 5% decline there, but again, these are not even close to approaching a 20% correction or 50% economic collapse like what happened in 2008, 2009. So basically, I've been buying into stocks over the past year, 2 years. My first position actually started down here in one of these big dips. It started September 28th, 2015, and since then I returned about 24% off the S&P 500. And actually, as I've gone on and learned a little bit more about stocks, I've been buying on some of the dips here into individual stocks, which I still believe there are individual stocks out there that are fairly priced, even though the market is totally overpriced at this point in time. The point of this video is just to share that while stocks have been doing quite well recently, and a lot of people have been making money in the stock market because of the Trump rally and a number of other reasons, there's a good chance that the market could take a significant decline here in the next, 6 months, a year. It might even happen sooner than that. Nobody can ever predict the movements of the stock market, but they can determine their investment philosophy. And for me, if the market were to decline by 50%, it would actually be one of the best things that could ever happen. It would be like going into your favorite store and seeing your favorite clothes or your favorite shoes were on sale for 50%. There's no reason why when the market declines by 50%, I won't double my stake in every one of my favorite companies, or more than double if I can, depending on how much capital I have available at the time. I'm really looking forward to a significant market decline and make the best of some of these opportunities here where global financial markets really panic and misprice some of the best assets in the world that will be income generating for the rest of my life. Thanks for listening. This is James here with Abbey Finance. Hope you learned something. Please leave a question in the comments, maybe even a suggestion if you have any ideas of how to improve this series. I'm just getting it started here. Please subscribe or give the video a like. Definitely check out my page on Instagram. The page is Abbey Finance. And yeah, thanks for checking this video out.